Hi there, Etoro. It is Monday, the 22nd of August, and that means it's time to take a look at what moved the markets last week. I know I've missed making videos for the past 2 weeks. Unfortunately, I was stuck in travel chaos for one of those days, but I'm back now. So let's take a look at the charts to start off with. So the NSDQ100 and the SP500 had a pretty rough week last week. You can see here that the trend has been upwards since the bottom in the middle of June or so. And the picture is very similar for the SP500. However, a decent chunk of those gains have been given back through the past week, and we can see that the market has opened fairly down today too. As I usually do, we also have this chart of the CSI 300, so the Chinese equivalent of the SP 500, and you can see that it has been dropping pretty consistently since February 2021. And although we saw a very strong rebound, this is a multi-month rebound, we've seen through the past, is this maybe 2 months, that it has been dropping off, 1 month, 1.5 months that it's been dropping off, and it's trying to rebound from there. I'll talk about the reasons for that in a moment too. And lastly, in terms of charts for this week, I have oil on the right. So there's a big fat red candle today since the markets are now open. And instead of oil traveling in the opposite direction to stocks at the moment, it's traveling kind of in the same direction, and I'll talk about why in a moment. What's fairly obvious though, looking at the price action for oil, is that the direction has been down for a while yet. So what caused this about face in sentiment? Well, I've been talking about it for a while, and I've been hedged for a while because it felt like the market had gone too far too quickly. Investors had been ignoring the statement, the old saying, don't fight the Fed, and markets had been rallying for a month and a half or so before they turned around. One of the primary reasons for this is because of the minutes that we got out of the Fed on Wednesday night for those of us in Europe last week. And in those minutes, we found out that the various members of the Federal Reserve were still fairly hawkish. They're okay with continuing to increase rates at a fairly quick clip for the next while. I think that the market had been banking on the central banks becoming a little bit more dovish, loosening up economic policy, or at least slowing down the pace of the rate hikes that we've been seeing around the world. And the Fed was saying, I don't think we're going to slow down. We need to see a trend downwards in inflation. It needs to be strong before we take any action that is different from what we've been saying in the past few meetings, months and quarters. And so what sums it up quite nicely is the highlighted text that I have from Reuters, which basically says, while not explicitly hinting at a particular pace of coming rate increases, beginning with the September meeting, the minutes released on Wednesday showed US central bank policymakers committed to raising rates as high as necessary to tame inflation, even as they begin to acknowledge more explicitly the risk that they might go too far and curb economic activity too much. And that's effectively the reason that the markets are pulling back now. They realize that the Fed is going to continue to hike those rates, as are other central banks around the world, if I were to guess. And that means that inflation, which is super high, and we're really feeling the pinch in terms of the prices of day-to-day things right now, we're also going to see a slowdown in GDP growth. So prices are going to go up, and things like wages are not necessarily going to go up to match them. Everyone's going to get a little bit poorer, and this will snowball into potentially a larger slowdown and maybe recessions here and there throughout the world. We're also at the tail end of earnings season. There are a few companies that still need to report. This is from August the 5th, but even at this point in time, 87% of the companies in the S&P 500 have reported. Obviously, there are a lot more companies than those just in the S&P 500, but I wanted to pull these stats out. So this paints quite a rosy picture. So 75 have reported above EPS estimates, and in this chart below you can see, for example, that energy companies are doing much better than communication services. Now, it's great that a large number of companies have been beaten on earnings, but we do need to remember that earnings have been revised downwards prior to going into earnings season. And these earnings estimates are usually coordinated a little bit so that they are slightly lower than the numbers that will actually come in. What I am a little bit concerned about right now is what the next quarter's earnings, the Q3 earnings, are going to look like. I think that the slowdown in economic activity is really going to hit home in those earnings that we're going to receive later on in the year. What I'm unsure about, though, is how to balance this with the fact that lots of companies in the economy do very well towards the end of the year. We have lots of holidays, lots of shopping events. People tend to spend a little bit more at the end of the year than at the beginning of the year, but we're going to have to see because inflation is really pushing prices up now. While we're on the topic of earnings, so one of my favorite businesses for many years reported last week. I didn't have very many companies. I think 2 companies in my portfolio reported, but Canadian Solar put out such a good earnings report that I wanted to talk about them briefly. This is a company whose share price has been absolutely smashed through the past year and a half, 2 years, and it's not very different from other companies within its sector when it comes to the price action that we've seen. The reason that I wanted to call Canadian Solar out is because it's one of the companies that aren't as loved as some of the other solar companies out there, Enphase, SolarEdge, First Solar, all companies that I also really like. But Canadian Solar's stock price, the value of its stock is much cheaper relative to those companies. Now, in part, that's because this company has close ties with China. It's a company that's headquartered in Canada, as you can tell by the name, but the founder is Chinese, and a decent part of their operations are in China. Now, I encourage you to go through the presentation of the earnings report. They beat on revenue and earnings on profitability by a huge, huge margin. And this is a bit of a surprise because solar companies have had a challenging time. Inflation really impacts them, as does all the challenges that still exist with supply chains and the shortages of semiconductors that are going on right now. The reason that I really like Canadian Solar is that it's a company that isn't known for its consumer-facing product. It's more a company that rolls out these mega projects for other big companies and for utilities within countries. It also has very close ties with the US, and these have been hampered somewhat because there used to be tariffs on solar imports from Canada to the US, but those are going to be lifted, if not lifted already. They've also got a fantastic structure and strategy around their supply chain, and they're further deepening their ties within China. They have a company, a subsidiary, that's listing within China, hopefully by the end of this year. Like a lot of other solar companies, they're also getting involved in the storage of energy. I think that a lot of companies that aren't involved in storage will start packaging this up to increase their product set. It's just something that dovetails very well with a lot of solar offerings. And if you look at the actual numbers, I've got a few of them up on screen. You can see, for example, that net revenues are up 85% Q-on-Q, 62% year-on-year. Their net income, their profitability is improving quite nicely, and they're a company that's just landing mega project after mega project. So I'll continue to hold onto my stock there for at least a few years to come. Now, one of my portfolio companies that isn't doing quite well, no longer a portfolio company actually as of today, is Cineworld. So Cineworld is the world's second largest cinema chain. Their share price rose incredibly through the tail end of the pandemic, let's call it that. It got very, very expensive, and I bought it at what I thought was a fair price after it had dropped more than half from the highs in that late spike. My thesis when it came to Cineworld is that it is a company that's been around for a long time. It's grown through acquisition, an enormous business that has operations all around the world. And despite the debt that they had taken on, they should recover very well once the world reopens and people start going to cinemas again. However, a few things have gone very wrong for Cineworld. So it's not on this document that I have up on screen, but first of all, they were supposed to acquire another cinema chain, a very big company, and they dropped out of that deal entirely. That company has now said that they are suing Cineworld for a huge amount of money, more than the company has in cash or revenue. And looking back, that was probably the perfect time to exit this position, just because the risk around it had increased so much. The people running this business actually have a very good track history, so part of my thesis was around them turning it around despite the debt that the company had taken on board. However, it seems that even though the world has opened up, we're not seeing as many blockbusters come out of the US drawing people into the cinemas as they used to. But also I think that people have been going out a lot more now that the world is almost entirely opened up, enjoying holidays abroad, for example, instead of going to the cinema. And this has translated into Cineworld not making nearly as much money as they had thought, and they have more or less just run out of time. And so in the middle of last week, they announced that they were going to go through an evaluation of strategic options to both obtain additional liquidity and potentially restructure its balance sheet through a comprehensive deleveraging transaction. Lots of big fancy words there, but effectively they need to have a huge injection of capital in order to continue to survive. 2 days later, it became clear that they were also looking at potential voluntary Chapter 11 filing. This is a type of bankruptcy process in the US, and this obviously terrified investors. There were a huge number of investors exiting their positions, and there wasn't enough liquidity in order for me to exit my Cineworld positions last week, unfortunately. Now, the Chapter 11 process is, I don't think many people know this, but it's a process for trying to avoid actually the company shutting down completely. Instead, it's a process where it's a last chance, where the company is saying that they want to try and find an agreement between debtors and investors that can somehow bring the company back to life. They might need to restructure the company, sell off parts of the business to raise funds. And sometimes companies come out of this process better than they were going into it, and they become very successful companies. I think Apple, at one point a long time ago, filed for Chapter 11. Hertz is a more recent example. I don't know if people remember Hertz going bankrupt, and then there was a whole hullabaloo about them trying to raise money through the stock market. But they were able to exit this process, and they've come out of it much stronger than the company that they were going into the process. But this is because they also got a bit lucky. Hertz, of course, owned a number of cars, and the prices of second-hand cars shot through the roof during the lockdowns for a number of reasons, and being able to offload some of these cars and parts of their business meant that they had more than enough cash, together with money that they got from investors and agreements they made with debtors, to exit this successfully. I'm not sure I see the same thing happening with Cineworld, particularly because of this lawsuit that I think is going to go against them. And half of me wonders if this is a strategy to try and wiggle out of that particular lawsuit too. Long story short though, this has become significantly more risky than it was 1 or 2 weeks ago. And actually, I should have realized this risk much earlier and exited these positions. But sometimes you get these things wrong. A diversified portfolio protects you from some of that. I still don't like taking the enormous 80% loss that I've taken on these positions, but I'll be sure not to make this mistake again. Another thing that's been happening through the past week, or actually longer, is that power prices through Europe have been surging. So it's no longer just natural gas, but it's also the price of electricity that's going through the roof. I'm not sure if you've been reading the news about the amount of coal that's been burnt, and coal companies are suddenly making huge amounts of money. The price of coal has been increasing. Shipping coal around Europe has become quite a difficult thing to do because of the heat waves and the rivers that are slowly drying up. Anyway, this is very worrying because this will make inflation particularly sticky. I am quite concerned that we might see stagflation in Europe. So stagnation and economic growth combined with inflation at the same time. It's a very difficult cycle to get out of. While we're on the topic of commodities, so I do keep a list that I track, and you can see that the good thing is that many commodities are dropping in price. So if you look at these, this is the weekly price, or the price 1 week ago, and this is the price 1 month ago. And for a lot of these, the prices have been dropping. That is, except for natural gas, which if you'd held on it since the beginning of the year would have given you a return of 162%. The energy problem isn't restricted to Europe, by the way. So China is having its own set of challenges. There's a heat wave making its way through many of the provinces there, and people are using huge amounts of air conditioning. There's not enough electricity to go around, and so there are blackouts and increases in prices happening there too. On top of that, so seeing as we are talking about China, sentiment within China is awful at the moment. We've seen the Chinese government do 2 more things to loosen up financial conditions within China, but it's just not having the effect or the size of the effect that they'd hoped for. And this is partially because of the sentiment within the country right now. So people are shunning debt, instead using savings, well, those people that do have it. And this creates a problem because China is such a large part of the global economy that if that economy isn't firing on all cylinders, it creates drag in other places in the world too. This particular article, a large part of it is an interview with someone in Shanghai, but this highlighted paragraph or sentence tells you everything you need to know. Recent surveys show Chinese households are more pessimistic about future income growth than they've ever been, even at the pandemic's start in 2020 or after the global financial crisis. So no matter the amount of money that the government is making available and the price at which it's making it available to the people within the country, people don't want to take it because they're worried about the future prospects. If they take on that debt, will they be able to build businesses and be able to pay it back somewhere in the future? And right now they're thinking, no, so I'm going to dip into my savings instead. One of the reasons for this bad sentiment in China is the very slow car crash that is the real estate sector within China. And you can see that this is one of the measures that Beijing has recently implemented. They've dropped the 5-year mortgage rate, trying to stimulate the real estate market, because at the moment it looks like there's just going to be huge numbers of buildings that are going to be empty for a long time to come. All right, so looking at what's going on this week. So we're getting PMI data out of Europe. So the UK and Germany are 2 areas that I look at quite closely. We'll also see a second revision on that GDP number in the US. If you remember, it was a negative number, so it meant that the GDP in that quarter had shrunk. We're now seeing the second estimates come out. There are an estimate for 3 rolling months for the previous quarter. But probably what the market will be most interested in is the core PC price index number. So for those of you that remember, This is the Fed's preferred measure of inflation, so hopefully that's going in the right direction. And we will also hear the Fed Chair Powell speak on Friday mid-afternoon. Investors will be very keen to hear what he has to say, and I think he'll probably need some of these data points before he finalizes what he's going to say, but they're hoping to find out more about the rate and size of increases in rate hikes for the coming quarters. Now, this speech will actually take place at a very important symposium, so that's the Jackson Hole Economics Symposium, and that will see central bankers from around the world and famous economists meeting in this particular location to discuss the hot topics of this year, as well as any mutual interests and how to overcome those. I'm guessing that there'll be lots of talks about inflation, interest rate hikes, etc. So the media is obviously speculating about what is going to be said at this meeting, and the consensus right now seems to be that they think that he will talk about their resolve to keep raising interest rates to get inflation under control. So the market expecting this probably won't be spooked if he does talk about that, but I guess we will see. All right, that's it for this week. I know that the news out there is awful. Things are looking very bad at the moment, not just in terms of the stock market, but also the global economic picture. But there's a little exercise that I would like you to carry out. It wasn't that long ago that the market was becoming incredibly bullish, and I think it became too bullish too soon, but that was a taste of what we will get eventually. So all of these problems that we're seeing in the world at the moment will eventually be solved by us, the humans. We, the humans, go through times of turmoil, shared turmoil that is quite challenging, and it's cyclical, right? So there are bad times, which are followed by good times, which are followed by bad times, which are followed by good times, so on and so forth. So in that rally that you saw recently, that was a taste of what we will get when the world has worked its way through these problems of inflation and interest rates and energy crises, etc. As part of this exercise that I'm asking you to undertake, find a company that you love but has been very expensive. It was massively overpriced through the pandemic, and you watched it decline, waiting for the right time to buy into that company because you knew that it was a good company. It was just the wrong price at that particular point in time. One such company for me is Shopify. And this is a company whose share price has been dropping more or less, and it was flat for a while, but more or less is down from July 2021. So I, like many other potential investors, watched the share price drop and drop and drop, and were a bit shocked at how low it was going, and then watched it go even further, and then also watched as it started forming a base, a little bit nervous to get in because the drop before this had been enormous. And then through the rebound that we saw in July, kind of August timeframe, saw the share price appreciate 40% in probably a few weeks, maybe a month. Now for me at this point in time, the stock was still a very good price, but obviously I was a little unhappy that I'd missed out on that 40% rise in the stock price. Now, I'm sure that you also have companies that you're watching, trying to get into, and maybe you've seen them appreciate off of the back of that rally. I have a company that I'm watching that jumped 60% in that short time frame. And maybe you were kicking yourself at not getting in because you knew it was cheap. You knew it was a good company, but you'd been scared out of the market like many other people because the stock is down, I think from top to bottom, something like 70-75%. Well, the good news for those long-term investors is that these types of companies will see this type of appreciation in the share price again when things turn around. And now the market has given you a second chance. We can see that Shopify has now dropped and given back a huge amount of those gains, giving me and others another chance to get this company at ultra low prices and then benefit when it does eventually rise again, and it will rise again. All right, thank you, and I'll speak to you soon. Goodbye.